Welcome to the Explainer. You know, if you've ever wanted to just look past a company's glossy PR and actually read its true financial DNA, well, you are in exactly the right place. Today, we're decoding the anatomy of a business through its financial statements. We're going to break down the complex metrics that the experts use to figure out if a company is truly thriving or if it's kind of just barely surviving.
Okay, let's dive right into this. How can a highly profitable company suddenly go bankrupt? I mean, it sounds like a total paradox, right? If a company's making money on paper, shouldn't it be doing great? Well, as we'll see today, and honestly as we've seen historically with some pretty massive corporate collapses, if actual cash flow isn't managed properly, even the most seemingly profitable firms can face sudden catastrophic failure. To understand exactly how that happens, we're going to logically deconstruct the complex machinery of corporate accounting into 5 digestible pieces. First, the rules of the game. Second, the 3 financial statements. Third, connecting the core statements. Fourth, understanding working capital. And finally, measuring health with ratios.
Let's start right at the foundation with Section 1, the rules of the game.
Before we can read the financial health of a company, we have to establish the basic physical laws governing how public companies must report their numbers. And this brilliantly illustrates a fundamental divide in accounting: accrual versus cash basis. Accrual accounting recognizes revenue the moment it's earned, and it matches expenses to that exact same period. This happens regardless of whether cash has actually changed hands yet. Cash basis, on the other hand, that only recognizes revenue when the cold, hard cash actually hits the bank account. Because public companies rely on the accrual method to perfectly match revenues with the expenses that generated them, it creates this fascinating and sometimes incredibly dangerous gap between theoretical profit and cold, hard cash. So to keep everyone honest under that accrual system, we rely on US GAAP, or Generally Accepted Accounting Principles. Authorized by the SEC and set by the FASB, these standard rules are the essential blueprint preventing companies from just presenting inconsistent or arbitrary data. They ensure financial statements are presented fairly and consistently, and ultimately, that protects you, the investors and lenders, from being totally misled. All right, now that we know the rules, let's move to Section 2, the 3 financial statements.
Think of these as the core organs of our business organism. Everything starts right here with the fundamental accounting equation: assets equal liabilities plus shareholders' equity. What this actually means is that every single resource a company owns, its assets, has to be funded somehow. It's either funded by borrowing money from third parties, which are your liabilities, or by owner investments and retained profits, which make up your equity. It's literally a physical law of finance. This equation must always balance perfectly.
Next up is the income statement. This tracks a company's accrual-based profitability over a specific period, like a quarter or a year. Think of it kind of like a video. We start at the top line with revenue and cascade all the way down through direct costs and operating expenses to hit metrics like EBITDA. Now, EBITDA is a huge favorite for investors because it strips out all the noise of capital structure and taxes before we finally arrive at net income, which is the bottom line. By contrast, if the income statement is a video, the balance sheet is a photograph. It's a static snapshot frozen in time. It captures a company's exact resources, its assets, and its sources of funding, its liabilities and equity at one single, highly specific moment. Think of it like the stroke of midnight on the very last day of the fiscal year.
And then we have the cash flow statement. This is broken into 3 steps: cash from operations, cash from investing, and cash from financing. Because the income statement uses accrual accounting, it can sometimes mask reality with non-cash expenses, right? Like depreciation on a factory, for example. Well, the cash flow statement acts as the truth serum. It elegantly strips away those non-cash accrual metrics, starting right at net income, and translates them into the actual physical movement of cash in and out of the business during that period.
Which brings us to Section 3, connecting the core statements.
These documents don't exist in isolation. They act as the nervous system of the business, intricately linked together to give us the full picture. So the absolutely crucial point is this: net income is the ultimate connector. As the bottom line of the income statement, its journey doesn't just stop there. It becomes the very top line of the cash flow statement. Simultaneously, it flows directly into the balance sheet, adding to the retained earnings under shareholders' equity. It is the central anchor holding the entire financial narrative together. Now, the cash flow statement also heavily links back to the balance sheet. It tracks changes in working capital, like your current assets and liabilities, and records capital expenditures, which updates property, plant, and equipment. But most importantly, That ending cash balance generated at the very bottom of the cash flow statement, that flows straight back to become the new cash balance on the current period's balance sheet.
All right, let's explore one of those key links a bit deeper in Section 4, Understanding Working Capital.
If the financial statements are the organs, working capital is the day-to-day blood flow keeping the business alive and liquid. The formula is actually incredibly straightforward. Working capital equals current assets minus current liabilities. Now remember, operating cash and debt are usually excluded from this calculation because they aren't part of the core, recurring daily operations. What this metric truly measures is a company's ability to pay off its near-term obligations. Bills coming due within a year, using its near-term resources. It's really the ultimate test of daily liquidity.
To measure how efficiently a company manages this liquidity, we use something called the cash conversion cycle, or CCC. It's calculated as days inventory held plus days sales outstanding minus days payable outstanding. Breaking that down simply, it shows exactly how many days it takes for a company to convert the cash it spent on inventory back into cash collected from sales. Generally speaking, the lower this number is, the better. In fact, highly efficient giants like Amazon often run on a negative cash conversion cycle, which is wild, meaning they actually get paid by their customers before they ever have to pay their own suppliers.
Now, what's really interesting about this is the working capital narrative it creates. It's a delicate survival act. A company wants to delay payments to its suppliers for as long as possible to keep cash on hand, while at the same time aggressively collecting cash from customers who bought on credit, all while turning over its inventory rapidly. If a company fails this balancing act, like letting receivables balloon or paying suppliers cash way too early, it runs out of blood. And guess what? This is exactly how a profitable firm can still go bankrupt. It's simply a timing mismatch between inflows and outflows.
That leads us perfectly into our final section, measuring health with ratios. This is where we kind of step in as doctors, taking the vital signs of the business to measure its ultimate health, efficiency, and creditworthiness. Let's see how these ratios build upon our understanding of profitability. We have return on assets, or ROA, which measures how efficiently a company uses all of its resources to generate earnings. Right next to it is return on equity, or ROE, which measures the efficiency of just the shareholder capital. And the fundamental difference between the two? Leverage. By utilizing debt, a company can seriously amplify its return on equity, making it look incredibly attractive to shareholders, but inherently much riskier.
When assessing default risk and credit health, we also look at coverage ratios. A multiple greater than 2.0x is generally the ideal benchmark for an interest coverage ratio, which is typically calculated as EBITDA divided by interest expense. If a company is operating above a 2.0x multiple, it proves it's generating sufficient cash flows to safely cover its debt obligations. For lenders, that is a major green light.
And that brings us to the core lesson of this entire explainer. As the source material bluntly puts it, at the end of the day, cash is king. Accrual accounting is an incredible, absolutely necessary tool for understanding true operational profitability, but because it relies on management's discretion for things like depreciation and revenue recognition, the income statement can sometimes paint a much prettier picture than reality. To survive, a business absolutely must generate actual, unencumbered free cash flow.
So, I'm going to leave you with this question. How will you evaluate the true health of your next investment? Now that you know how the income statement, balance sheet, and cash flow statement all interconnect, and how working capital essentially dictates survival, you have the analytical toolkit to look right past the top-line hype. I really encourage you to apply this directly to the next company you research. Thank you so much for decoding the numbers with me today on this explainer, and I'll catch you next time.